Hi, it's Harry for the Rant on Friday, September 23rd. What a time to have a rant. The markets have gone kind of crazy here. Things you don't usually see coming into a recession. If we look back at the last one, okay, coming into 2007, stocks peaked in early October, but bonds, TLT, the 20-year bond average, treasury bonds, basically started to turn up ahead of stocks. So bonds saw, the quality bonds, the treasury bonds saw the recession first, and then stocks. And you know, stocks were ahead because the recession didn't start until very early 2008, and then it was the deepest we've seen since 1982 or 30 to 32. So what's happening this time is TLT is going down, down, down. This should not happen, except what really happened here is the central banks, even though they've been getting away with murder, stimulating, unprecedented, nonstop stimulus all the way back to early 2009, the markets haven't punished them for this, okay, particularly. But they went overboard in COVID, okay? As I've been saying, you know, they panicked and $10 trillion, half of it fiscal, which is more inflationary, and half of it monetary. And so we do have serious inflation. And again, this inflation is entirely artificial for the first time due to stimulus, okay? My inflation indicator is the best in the world that I know of, and it says inflation should be more like 1%, as it has been coming into this. So this jump up to over 9% and now back to like 8.3-ish, that's the problem with the markets here. Inflation is the highest we've seen in a long time, and it is stubborn. It is not backing off even with this initial tightening, and it means the Fed's going to have to keep tightening, and that's not good for stocks, and it means a slowing which will bring risk-free rates, treasury rates, down to near zero on the 10-year. But guess what? The markets are still reacting, particularly treasury bonds. TLT is still reacting to the high and stubborn inflation. It obviously is saying, after the Fed just raised rates 0.75 of a point, 0.75%, it wasn't enough. I was surprised that they didn't even predict that 1% would have been on the table. It was like, 80% chance of a 75 basis point hike and 20% roughly of a 50 basis points. I just thought a slam dunk would have been 1%. Show you're behind and show you're serious about inflation. But, you know, the markets are saying it wasn't enough. The markets don't like what's happening. So TLT is our prime place to be, and the least volatile as well, that rallies and does well in a worsening recession. Now, TLT peaked at 179.70, okay, all the way back in March 2020, in COVID time. This is when COVID was hitting, okay? And then it bounced again and went up to 155.12. So 155 in December, early December of 2021. It's been falling ever since. It broke my megaphone pattern. And we warned people there's only a minor break at first, not that serious. You could hold if you want, but you do want to get back in if it goes down, and then can go back and steadily be above 107, which is really where the support is. Now, when I look at it, having broken, it looks like it's going to be down to 104.30, 40, 50. So down in the 104 range this morning when the markets open. This is coming before that. So what is the real support? The real support all the way back to 2012, early 2013 is 101. That's where the market should find strong support. So people who got out of TLT or are looking to get into, that would be the obvious point. If you want to be even more safe, let it go down, test that level if we get that low, or maybe a little lower, and wait until it comes back above this 107 level where it really should have held. I mean, it really should have held here, and it didn't. So that just shows that we have extreme inflation from extreme stimulus in the last 2 years since COVID. So again, the central banks and the Fed have been able to get away with murder, have not been punished by the market for endlessly printing money, but they are being punished now, okay? And so they are going to have to keep raising rates aggressively to get the stock market to come down more and to get the economy to slow. And again, what the markets are saying, they know a recession's coming. Everybody thinks a recession's coming now, but the markets are still more worried about inflation than recession at this point. And there will be that subtle point when that changes. That is going to change, and it's probably going to happen very soon, that all of a sudden the markets will say, okay, the Fed now is tight enough, or look like they're going to tighten enough, that we are going to slow, and then inflation will go down more aggressively. So that's what we're looking for, and this is a tough time. I think TLT is going to be a super buy again at 101. If you didn't get out, I think at this point we're only talking $3 on the downside. It opens up around 104 something today, so it may really be too late to get out. But people who are out can either get back in at 101. That's the most aggressive play here. That's probably the cheapest you'll ever see it. And or a little more safe, wait till it can clear back over 107 again and show it can hold that level. Because remember, the target on the upside through the tops in the last several years is still 196. So number one, this is the most volatile time ever in Treasury bonds. There's not a time I can go back in history. This is the biggest fall from 180 down to 104ish here, and maybe as low as 101, probably likely ahead. And it'll be the biggest rally if we go from 101 or 104 here up to 196 in the next year and a half. And that's what the charts say. Now, charts aren't perfect, but that's my best bet. We'll never see a buying opportunity in the highest quality bonds, long-term bonds, 10 and 30 treasuries ever again in your lifetime. There hasn't been one in the past, and there will not be one in the future. So big opportunity. Apologize for the people that got in TLT and have been beat up here, but I don't think there's much more downside, and the upside is huge. And of course, stocks, remember, they've seen their first wave down. They've bounced and retraced 50%, as I'm saying. Perfect first wave down. I would have liked to see it be a little more, 40% in the NASDAQ instead of 34. That's the lead dog here, but stocks do look like they've started their third wave down, and as soon as they break convincingly to new lows over the June lows, then we're going to be well into wave 3, and the stock market's going to be down 50 to 60% by early next year, and then people are going to know for sure that we are in the downturn, the crash of our lifetime, and it still will have another big wave at least to go down. 86% down on the S&P is what is my forecast for stocks, and 92% for the NASDAQ from their highs. NASDAQ peaked in November 22nd, 2021, and the S&P January 4th. So stocks are going to go down much more. Bonds are going to have the rally. Only the highest quality treasury bonds, not corporate bonds. You know, AAAs may do okay, but you want to be in 10 and 30-year treasury bonds. ZEROS is the most leveraged 25-year average, as I've been touting, and TLT is 20-year average and the most liquid and easiest to trade. So again, rally in a lifetime for bonds, crash of your lifetime in stocks. Bonds are about to start, stocks are well on their way. I'll keep you updated.